This question comes from Doug DeShiel. Since the accounting rules changed requiring Berkshire to report the change in fair value of its equity investments through the income statement, Mr. Buffett has repeatedly told shareholders to ignore those changes as they're not reflective of the long-term returns that those investments will produce. Recently, Mr. Buffett has argued that hold-to-maturity accounting used by the banks to avoid reflecting the changes in fair value of bank investment portfolios in the income statement and the shareholder equity account do a disservice to its various stakeholders. Can Mr. Buffett elaborate on why he views mark-to-market accounting differently for banks in comparison to Berkshire?
I believe in both cases in doing it on the balance sheet and not in the income statement. And it's a very tough problem that the auditors face, is that obviously the income statement feeds into the balance sheet, but the balance sheet tells you whether deposits can be paid. It tells you a lot of things, and we show it on our balance sheet. We believe in showing market values on our balance sheet. We just don't believe in running it through the income account. And in getting there, we would put it in other comprehensive income like it was for a long time. So I sympathize to some extent with a far extent with the audit group, but they have to really decide whether they want the balance sheet to represent values, except it doesn't reflect them on the upside. If we buy a See's candy and it's worth way more money, so it's conservative in that sense. Or whether they want to have an income account that becomes meaningless to people because it really changes every 5 seconds. I mean, the market's closed today, but we have days. Well, I guess Apple was up 7 or 8 points on Friday. I mean, that's $7 billion. I mean, that's a crazy income account. It is a reflection of where we stand at that point. And of course, if you're a bank where you're putting out money really in things that people sort of mortgages, I mean, primarily, they're a terrible instrument for a bank to own, but a great instrument for a consumer to buy and build into the whole society now in a way that was entirely different than the past. You've got to pay attention to whether they've gotten out of whack in terms of what the value of what they own and what can be demanded of them tomorrow morning. And if we had all of our money that could be demanded from us tomorrow morning, we'd have to behave a lot differently than Berkshire does. So I really think the way to do it is the way we recommend doing, which is exactly what was being done until a few years ago. I recommend the shareholders look at it that way, but we're going to follow the rules, obviously, that the SEC, state authorities and everybody require of us. But I'll still explain to the shareholders exactly what I would explain to my sister about what really counts at Berkshire. And I think every management actually has an obligation to that. And instead of it, they go in the other direction and give them a lot of figures that are total nonsense. You can't imagine some of the, EBITDA I thought was about as bad as you could get, but they kept going, and earnings before everything, EBE. So, but that doesn't change what I would tell my sister, who's here in the audience, I hope. And I should tell all the shareholders, and we'll consistently do what is legal, and we'll consistently say what we think is right. Charlie?
Yeah.
We want owners who understand what they own. Now, that doesn't mean they have to understand the detail of it, but that's why we have people that have been around 50 or 60 years. That doesn't mean that they read the 10 Qs or anything like that, but they feel we're telling it to them like they live next door to us.
Yeah, I don't know what the accountants were thinking when they made that change. It strikes me as bonkers.
Yeah.
Absolutely bonkers. I don't see how anybody who understands how business is really operated and should be operated by owning managers would have made that accounting change. The accountants did it just because they had a wild moment.
25 years ago, I suggested to the audit profession that the audit committee ask auditors 4 questions, and the shareholders would know a lot more about the company if those questions were asked, but it wasn't good for the auditors to be asked those questions because it might increase their liability if they answered them, and the client didn't want them to answer them because the management didn't want them to.
No, they want a system where if they follow certain rules, they're safe, and that's understandable. But I don't think the passed this rule requiring changes in marketable securities to go through the income account quarterly. They didn't do that to protect themselves from liability. They just did that for some crazy reason of their own.
Yeah.
You get a bunch of people who are all drawing a lot of pay out of a big complicated system and rising in it like so many officers in the Army. God knows what they'll do if you put them in a little room by themselves and tell them to invent new accounting standards.
Well, to our auditor, remember that's Charlie talking. But I agree with him 100%. He's 99. He can get away with more than I can get away with. Okay, station 2. But what he said is enormously important. I mean, it just, you got to have some insights into what the hell really goes on. And
even if you're an accountant.
Yeah. Okay.